Welcome to this video. Today we talk about an overview on the importance or role of contracts in international trade. What are contracts? Why we need to have a contract? Contracts are a written agreement. They are legally binding and they are between mostly the buyer and seller, the importer and exporter, who are on different countries. These agreements outline the terms and conditions of the sale of goods or service, when and how delivery happens, when and how payment happens, when and how the risk or the ownership transfers, the title, when and how, in case there is a dispute, it will be resolved, where it will be resolved, and what are the actual description of the expected quantity and quality of the goods as well as the prices. These are essential for managing the complexities of a cross-border trade. What are the key elements? Most important of them is it will define who are the parties, the buyer and seller. What are the goods, the quantity, quality, description, unit price, packing, the price and payments, the total cost, unit cost, currency, how the payment will be made. Is it through LC? Is it advance payment? The delivery terms. What is Incoterm? Is it FOB? If it is CFR? Who will be responsible for transport, for insurance, for risk? All these are covered by the Incoterms. Then comes the time frame. When the goods will be shipped, when the money will be paid, when the goods has to reach, well, if an LC is to be opened, how in advance the LC has to be opened. So the time lag between different events that will be agreed. Then is the risk allocation. In case of a loss, in case of a damage, in case of a delay. So damages and delays are painful in the form of financial impact it has for both the buyer and the seller. The risk allocation is taken care by the Incoterm, and the compliance, who is responsible for arranging maybe customs clearance, maybe documents that allows customs clearance, etc. What tariff will have to be paid, what standards will be adhered to, etc. Then comes the force majeure situation. In case of an unforeseen event like a disaster or a war, who will be excused from performance and in what situation. So if you look at 2025 situation, contracts are increasingly becoming digital. Some people are using smart contracts using blockchain. Then there are various technological advances that makes it LLMs will draw up the standard contract. AI will tell you when and how quickly you can advance. So there is a rising protectionism in certain markets, and because of that, and in Europe you can find sustainability requirements, and then there are certain shifts in the way supply chain happens, the global supply chain, physical, because of the nearshoring, offshoring, onshoring. All this makes it very necessary or very important to have a clear contract. So compliance issues, you have to take care of the contract. Dispute resolution, you have to make it clear. In case of force majeure, who will handle that, you have to specify. You also have to specify which goods will be delivered when and how the payment can be expected and what are the time frames. Let us look at a case study. For example, an Indian textile manufacturer, maybe we can name them Textile Innovations. They are signing a contract with an Italian machinery supplier, maybe hosiery machine or whatever. Then the company called Macchine Tessili will be agreeing to sell. The order value can be, say, $5 million, and then what they will be selling is the automated looms, and the factory is in Gujarat, India. So the goods will be scheduled to get shipped from Genoa, Italy to Mumbai, India by sea, because these are the two connecting seaports, and then by late April via ocean freight the shipment will happen. The contract terms are CIF Mumbai. CIF means along with the cost the party will have to bear insurance and freight also up to Mumbai. Let us look at how the trade regulations and the documents will be required. So we have seen parties are Macchine Tessili and Textile Innovation. Goods are 50 automated looms, ISO 9001 standards along with these spares. Price is $5 million in US dollar terms, payable via letter of credit 60 days after shipment. Delivery will be CIF Mumbai terms. So seller pays insurance and freight, but the risk transfers the moment goods are put on board the vessel in Genoa port on whenever they are shipping. For example, they effect the shipment on 25th of March. What's the time frame? The goods are expected to reach before 20th of April. The payment is by LC. HDFC Bank will open the LC, for example, They will call for documents like bill of lading, invoice, insurance certificate, etc. Then what we have to comply with? The seller has to provide a certificate that these goods are as per EU safety standards, because it's coming from Italy and EU has a standard CE certification. In case of a dispute, the contract should say that they will be resolved as per the UN Convention on Contracts. CISG is nothing but Contract for International Sale of Goods. And then in case of a force majeure, we have to say in case of a geopolitical tension, if something goes wrong in India or Italy, who will take care? Or while the ship is on the way, suppose in Red Sea there is a disruption, who will handle? Or if there is a natural disaster, who will handle? All those aspects should be covered by the various aspects of the contract. Now, what could happen or what could go wrong? Let us see the transaction flow. On 15 February, the contract is signed. Maybe they use blockchain or smart contract. On 20th March, the looms are ready and they are sent for export clearance, we can say. And then shipping will be arranged. Euro India will be the shipping company who will handle the shipping. On 25th March, the goods are loaded at the port. BL is issued. You have a shipped BL. So the moment goods are put into the control of the carrier, the risk transfers to the Textile Innovation, the buyer. Though the costs are borne by the seller for the inland transport and freight, and even insurance up to Mumbai port is paid by the seller. On April 18th, the shipment reaches Mumbai. So March 25 they send the shipment, April 18 it reaches Mumbai. The moment it reaches Mumbai, it has to be cleared. That will be taken care by the Textile Innovation. They have to pay import duties. And for example, suppose they say pay 150,000, or maybe 150,000 will be the freight, which is taken care by the supplier. The inland transport or something is also taken by the supplier. 25,000 insurance taken care by the supplier. But the import duty at Mumbai port is taken care by the buyer. They will pay around 500,000 maybe. And then on April 20, the goods are released and reaches the Gujarat factory by road. And then the documents also are released by the HDFC Bank, finding them to be compliant, and payment will be 60 days from shipment. Shipment was made on March 30. So from that date, if you look at 30 days, maybe by May 30, the credit will be in the account of the beneficiary, unless they do some discounting or any prepayment arrangement. This is how the contract will help the parties. Now, what are the challenges that the parties faced in this transaction? One is a shipment delay. There was a disruption in the Red Sea. It caused a delay in the arrival of the ship. Instead of 15th of April, it reached on 18th April, 3 days. Now, there is a force majeure clause because the delay in Red Sea is not controlled by the supplier. So, Macchine Tessili is excused. They paid the freight and it's over. The risk also transferred to the buyer the moment it was given to the control of the carrier or the ship. So, Textile Innovation has to bear the damage caused during the transit. Then there was a damage to the goods. What happened? Due to humidity, there was a 5% damage on the looms, which cost around $250,000. Now, the shipper, Macchine Tessili, had given an insurance policy or insurance certificate as per the LC terms, and so the Indian party can claim under the insurance. The shipper need not pay anything, but this 5% is taken care by way of a insurance because the Incoterm in the contract helps them to handle this damage. Then comes a dispute with respect to customs, because Indian customs claimed that there is no BIS certificate, there is only a quality certificate from Italy, and so there will be an additional penalty or charges to be paid. And so there was a 10,000 fee that the Textile Innovation has to pay extra. But for this also, the contract is very clear, because Macchine Tessili is not responsible and the customs related things in India has to be taken by Textile Innovations. So Textile Innovation will have to pay some $10,000 fee, get the goods cleared. So because the contracts are clear, this dispute, damage and delay is handled in a fashion that there is no irritants between the buyer and seller for this transaction to happen. Now, what are the outcomes or what are the insights that we get from this transaction? The looms arrive, they are installed. Macchine Tessili receives 5 million. 4 million is their cost, while they paid some 500 plus thousand for various additional expenses. Clarity is there because it was CIF, risk management is there because force majeure was addressed, flexibility is there because the contracts were digital and instantly managed by the parties. The insight is that there is a precision in the contract drafting. There was adaptation because it was declared in case of a Red Sea disruption who will be responsible, because it was to ensure that the contract will arrive timely, and if not, who will be responsible. Then there is a legality of the contract because arbitration clauses were invoked in the guarantee clause. And then there was a risk allocation because of the CIF, the risk transferred to the buyer, and Red Sea issue did not affect the seller. So from this case study, we can fairly assume or understand or find that proper clarity in the contract serve as a foundation for the successful transaction between two parties in two different countries. Thanks for watching this video. We will catch up again in another session.